You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the deep dive. Okay, our mission today, it's really key. We've waded through a whole stack of source material, a full macro market briefing. FX, commodities, trade, geopolitics, the works. And we need to cut right through it, get straight to the single biggest thing moving markets right now, the U.S. federal government shutdown.
That's absolutely the right place to start. I mean, this shutdown, it's not just some domestic issue. It's the main driver globally right now. It's injecting this huge amount of uncertainty, setting a tone, really, of political instability that's, well, it's filtering into every asset class, everywhere.
And what's different this time, based on what we're seeing, is how quantifiable this uncertainty feels. It's coming straight from the Senate, rejecting that stopgap funding bill they needed. So now investors are looking at, the real possibility of delayed economic data. We're talking crucial labor stats, things like that, plus confusing messages on policy, all because things are basically shut down or just scrambling.
Exactly. And when the market can't, trust the timing or even the integrity of official data, risk appetite just evaporates. Policy signals get completely muddied up and traders, well, they pivot fast. So let's maybe unpack the immediate effect, starting with the most sensitive indicator, the U.S. dollar.
Okay, let's do that. The dollar. It took immediate hit, slid right down. That seems like pure cause and effect. Shut down uncertainty, the data vacuum we just talked about. But, money has to go somewhere. So where did this fear trade actually land?
Well, what's interesting here is how targeted the flows were and resilient. The Japanese yen, the JPY, it's leading the gains. Safe haven demand is definitely accelerating. But, and this is important, its strength isn't just about fear. It's kind of a dual narrative supporting this move. You had the Bank of Japan Tenkan survey recently, and while the details were mixed, it didn't really undermine the market, thinking that, hey, maybe they're actually looking at potential policy normalization steps soon.
Okay. So the yen gets a boost from being the go-to fear currency, and from this growing feeling domestically that the BOJ might actually maybe tighten policy. That makes it feel like a much stronger move, doesn't it? More resilient than just a knee-jerk reaction to the dollar falling.
Precisely. Yeah, it gives the yen move some real depth. Meanwhile, if you look across the Atlantic, the euro and the pound, they're a bit firmer against that weaker dollar. Traders over there are sort of processing their own local news. You've got the Eurozone flash inflation data, which gives clues about the ECB. And then whatever light UK headlines are managing to break through all this macro noise.
And if we just zoom out a tiny bit on the dollar, the sources mentioned that even before this shutdown chaos, the Fed's recent talk was already kind of capping the dollar's strength. How does that fit in?
Right, connecting it to the bigger picture. Remember, the Fed's been signaling this cautious approach. They keep stressing, they need to see more cooling in the labor market to be sure inflation heading back to target. That whole rhetoric had already put something of a ceiling on how much support the dollar could get from rate differentials. The shutdown, it just, kicked the legs out from under that already cautious foundation.
Okay, let's move down to the Asia-Pacific, the Antipodes.
Yeah.
The Australian dollar looking steadier. The Reserve Bank of Australia kept policy steady, but they sounded pretty hawkish, right?
They did, yeah. They really stressed the ongoing inflation risks, which, normally supports a currency. But that hawkishness was kind of counterbalanced. You had softer local PMI numbers, the manufacturing indices, and the fact that China, a huge trading partner, is shut for Golden Week. That really limits how much the AUD can gain right now.
But sticking with policy for a sec, there's this really crucial development, international cooperation. It almost feels like the opposite of the gridlock in D.C. Tell us about this Washington and Seoul foreign exchange statement.
Yeah, this is actually a really positive signal for stability, kind of flying under the radar maybe. Washington and Seoul put out a joint statement, concrete pledges on policy. They're committing to avoid, competitive currency manipulation and limiting interventions only to times when markets are genuinely disorderly. But the really interesting insight for you, the listener, is the transparency bit. They agreed to share monthly details of any operations they conduct. That guidance matters a lot for the Korean one, the KRW, which is super sensitive to capital flows. So this coordination is a vital step towards managing stability in the region, sort of separate from the U.S. chaos.
Wow, that level of public transparency in FX management, that really is significant. Okay, so if fear and policy expectations are driving currencies, is that same dynamic happening in commodities, or are we seeing different signals fighting through the shutdown noise there?
Moving over to commodities, what jumps out right away is that classic flight to safety. Defensive assets. Gold has started climbing again, holding near those fresh all-time highs. This is the simplest reaction, really. You get a softer dollar, plus this high level of U.S. political uncertainty. Boom! Demand spikes for assets that people think hold value in a crisis.
Right, but here's where it gets tricky, isn't it? On oil, crude is still heavy, as the market says. Selling pressure remains, even though OPEC publicly shot down those reports about a big 500,000 barrel a day production hike from some members. Why is the market still selling if we get news like OPEC denying an output increase? That sounds bullish.
That's exactly where you see the conflicting signals really clearly. The OPEC denial should be bullish, you're right. But the market seems more focused on weak demand signals closer to home, particularly in the U.S. We got those private U.S. inventory numbers, and they added some nuance. Yes, there was a crude draw, inventories fell, which usually helps prices. But crucially, that came alongside big builds in the refined products, gasoline and distillates.
Ah, okay. So we're using up raw crude, but the stuff that gets turned into gasoline, heating oil that's piling up. That suggests refineries are busy, but maybe end-user demand is weak, which pulls the price down ultimately, right?
Precisely. That combination, strong production, but potentially softening demand for the actual fuels people use, that's what's keeping the selling pressure on, even with OPEC trying to, urge restraint before their weekend meeting.
Got it. And just quickly on industrial metals, like copper, are they just stuck in the same uncertainty loop?
Copper's up a tiny bit, fractionally firmer, but any gains are really constrained. And again, it circles back to the global calendar, major Chinese markets being closed for Golden Week limits, physical demand right now. And participants are basically just watching that U.S. data calendar, waiting for direction. No U.S. data means no real momentum. So you just see this waiting game play out.
Right. This inability of Washington to function.
Yeah.
It creates a vacuum, doesn't it?
Yeah.
And our sources suggest other global players, trading blocks, they're kind of using this moment of U.S. paralysis, pushing ahead with some pretty aggressive, large-scale trade moves.
Absolutely. I mean, look at the European Union. The European Commission is gearing up for a massive trade action. They're looking at lifting import duties on foreign steel to levels like the U.S. and Canada have. Discussions are apparently pointing towards tariff rates, possibly around 50%. That's a really clear shift towards protectionism, matching North America.
It's 50%. Wow, that's a huge barrier. That would completely reroute global steel trade.
Yeah.
And they're also moving ahead on other fronts, targeting December 5th for signing the EU-Mercosur agreement.
Yes, exactly. And if that gets finalized, it would fundamentally reshape trade flows, agricultural, industrial, between those two major blocks. It's a big deal.
The complexity of global trade security right now, it's kind of dizzying. We also saw that really critical insight about supply chains. Taiwan reportedly turned down a pretty major U.S. request to produce half its chips domestically in America.
Yeah, that really underscores the diplomatic strain, doesn't it? And the reality that these ambitious goals for supply chain security, they often bump up against the existing, deeply embedded global manufacturing setup. It's not easy to just shift things like that.
That sounds like a major sticking point diplomatically. But on the plus side, you mentioned some bilateral facilitation happening.
Yes, that's right. Complementing that FX coordination with Seoul we talked about, the U.S. and South Korea are setting up a new working group, specifically to make visas easier for Korean companies investing in the U.S. That's practical stuff, boots on the ground support for investment flowing across borders. And Japan's being careful, too. Their economy minister announced a planned investment program heading to the U.S. will be managed very specifically to avoid causing disruptive FX effects. It feels like everyone else is trying to carefully manage their cross-border economic ties. Maybe except the U.S. Congress right now.
Speaking of careful management, or maybe the lack of it, let's pivot to geopolitics. This continues to frame that highest level of global risk sentiment, right?
Yeah.
And often drives those safe haven flows we started with.
Yeah, the Middle East. Tensions are still very active there, injecting risk both maritime and just regionally. Yemen's Houthi movement claim they hit a Dutch-flagged vessel with a cruise missile. That's a direct military action. It immediately adds risk to shipping lanes, pushes up insurance premiums, things like that.
And diplomatically, Hamas told mediators that any ceasefire deal needs really firm guarantees. on Israeli withdrawal, on compliance.
That suggests there are still some pretty fundamental hurdles to overcome before any kind of lasting resolution is possible there. Significant hurdles.
And we also see Iran reacting to European pressure about its missile program.
We do. Iran's Revolutionary Guard basically signaled they could extend their missile range if Europe keeps pushing them to limit the program. So that just adds another layer of tension, doesn't it? Around sanctions, regional security debates, it shows how trying to constrain capabilities can sometimes just lead to defiance, maybe even escalation.
Okay, let's bring it back to Europe. There's that huge security concern in Ukraine. Authorities warned about a critical situation at the Zaporizhzhia nuclear plant.
Yeah, shelling has apparently hindered restoring external power. The IAEA is involved, trying to engage both sides to stabilize the offsite electricity. But that potential for disaster, it just constantly hangs over the European risk premium.
And this brings us right back to that theme of gridlock, but this time in Brussels. EU capitals still haven't finalized the next round of Russia's sanctions.
No, it seems like there's significant political friction holding that up. And what's more, Italy's energy minister noted the bloc hasn't reached consensus on banning Russian LNG imports before 2028. So that failure to agree means that specific, very profitable channel for Russian gas trade, it stays wide open for now.
So, wow. We started this deep dive talking about paralysis in Washington, and we're kind of wrapping up seeing sanctions stalemate in Brussels, major diplomatic hurdles in the Middle East. What does this intersection tell us, this mix of political gridlock and just simmering global conflict? What's the takeaway for the current market tone?
Well, if you synthesize everything we've just gone through from this briefing, I think you have to conclude that markets right now are really defined by this failure to reach political consensus. Yes, we see bright spots, like that U.S.-South Korea visa group localized cooperation, but those successes just seem dwarfed by the shattered hast by this broader global friction.
Okay, so based on all this dense material, boiling it down, what are the 4 absolute key themes you need to be watching for the rest of this week?
Okay, number 1. Definitely the specific duration of this U.S. shutdown and its concrete impact on the economic data calendar. If key labor stats get postponed, expect serious volatility. Market participants will basically be trading blind. 2, the outcome and, crucially, the signaling from OPEC's weekend meeting. Watch how that stacks up against the ongoing oil price action we discussed, those conflicting signals. 3, keep a close eye on the euro area's inflation print. That's going to be critical for setting the future tone for the euro and for figuring out the ECB's likely rate path.
Right. And number 4, the final key theme.
Concrete movement or lack thereof on those European steel tariffs. Will they actually pull the trigger on 50% duties? And relatedly, any verifiable progress, any real advancement in Middle East ceasefire diplomacy. Those 4 things really are the main indicators of whether stability or maybe further escalation wins out in the coming days.
Okay, that framework, that's exactly what we needed. It really helps cut through the noise in all this source material. Thank you for walking us through such a comprehensive analysis.
My pleasure. And maybe I can leave you with just one final thought, perhaps a bit provocative. Look back over every major point we covered today. Despite those pockets of progress, like the U.S.-South Korea FX transparency or the visa facilitation, the big picture, the overall macro market tone, it's just dominated by this failure to achieve consensus. Whether it's Washington shutting down, or Brussels unable to agree on banning Russian LNG, or the Middle East struggling to get firm ceasefire guarantees, it's everywhere. And this suggests that political gridlock itself, this inability of major powers and blocs to find common ground on critical issues, maybe that's the highest premium risk currently priced into FX and commodity markets, that lack of agreement. That's what's defining today's volatility. And it seems like it's the one thing that these smaller, successful bilateral deals just can't quite outweigh right now.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.